Today on InvestTalk, we talked about falling rental prices in America, answered questions on regulatory issues with Google, VCSH, and TPH, and ended the day talking about how maybe the markets are becoming less efficient.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today concerns this question. Are rental prices finally coming down in America? And that's because recent trends indicate that rental prices may be on the decline, with asking prices for new lease rents rising by less than 2% over the past year. So let's dig into this. Well, as I mentioned, finally, there appears to be some relief in sight for renters after years of persistent price hikes. Rental prices that skyrocketed during the pandemic are really now cooling off, and in some cases even falling. But before we celebrate, it's important to recognize that rent prices are still 33.4% higher than they were before the pandemic. So while rental growth seems to have slowed from the major spikes we saw in 2022, not all rental types and areas are feeling the same effects. So what's next? What's next for rental prices? Well, there's evidence that growth is finally slowing down. For example, in July of this year, rents were only 3.4% higher than at the same time the previous year. That's a major change compared to the double-digit spikes we've seen in recent years. In fact, in half of U.S. counties, the rent increases from June 2023 to June of this year was the smallest in over 3 years. Nearly 3/4 of counties saw smaller increases than the year before. And now the cooling off depends, I would say, on what kind of rental you're looking for. Multifamily rents, for example, were down 80 basis points year over year, according to Apartment List. On the other hand, single family rents are still rising, though we have to admit it's still at a slower pace, up 3.4% in March. So as more build for rent properties hit the market, that increase is likely to shrink even more for renters in notoriously expensive places. There's also good news. Of the 33 major metropolitan areas analyzed, Austin, Jacksonville, San Diego, San Francisco, and Tampa saw the biggest drops in asking rents. But of course, it's not all rosy. Some metro areas like Hartford, Cleveland, Providence, Louisville, Richmond, they're still experiencing rent increases. So why are rents finally falling? Well, it boils down to supply. We talked about this already at the top of the show when we were answering that caller question. The past 2 years have seen a surge in apartment construction, something that is likely to continue. And while new multifamily building permits have slowed down, there is still a near record number of units under construction. In fact, last year saw the most new apartments in the market in over 30 years. 30 years. And so as more apartments come online, the pressure on rent prices eases. That's easy to understand. Additionally, more new homes are finishing construction, which could help some renters make the jump to home ownership, especially as rates come down. But for those priced out of the housing market, single-family rentals are still in demand, and that's what's keeping those rents relatively strong. So while we're starting to see some relief, the rental market is far from uniform. Just like the housing market is far from uniform. Some areas are seeing rent drops, others are seeing prices continue to rise. But with more supply hitting the market every month, and as we expect that trend to continue, the long-term outlook for renters is starting to look more promising. Now, welcome back to InvestTalk, and let's talk a little bit about the market today. U.S. stocks were higher, though ended a bit off of best levels. Today's upside came after a Friday sell-off that capped off the worst week for the S&P 500 since March of last year, and the NASDAQ since January of 2022. And that was really driven by a sizable sell-off across big tech and the semi-space. Big tech, though, today was mostly higher, though Apple and Google were notable laggards. We might talk about one of those and the reasons why a little bit later on. And today's outperformance overall included the semi-space, IT services, cruise lines, copper and steel metals that didn't do too well last week. Underperformers included department stores, cosmetics, managed care, China tech, casual diners, and media. Dollar index was up 40 basis points. Gold finishing down 30 basis points. Copper, as I just mentioned, finished up 1.7% after selling off 3.3% last week. WTI crude ended up 1.5% after a notable sell-off last week, about 8%, and which saw it fall to its lowest levels since June of last year. Overall, a very quiet session. A few catalysts as the market rebounded off of that weakness that I mentioned last week, but really continues to wait for key events, namely the FOMC meeting on the 18th of September. The 25 versus 50 basis point cut debate will still unsettled, but the market's continuing to price in just a 27% chance of a 50 basis point cut, despite what we saw last week, which was elevated growth concerns following August headline payroll miss and fears that the Fed may be behind the curve. But the report didn't really seem bad enough to push the Fed towards the 50 basis point cut. And so, in addition to this shallow rate cut path, there's some bearish news, right? There's some fresh scrutiny around the AI trade. There's some weakening consumer spending trades, particularly for lower income consumers. There's that negative September seasonality I mentioned at the top of the show, and still that overhang from the yen carry trade unwind early last month. It was a fairly light economic calendar today. The New York Fed survey of consumer expectations showed inflation expectations really remaining unchanged at the 1 and the 5 year time horizons. Unemployment expectations over the next year ticked a little bit higher, though not really notably. And so Wednesday's August core CPI is what's in focus in terms of the macro data this week. The headline expected to hold at about 20 basis points month over month, which makes it 3.2% year over year. Though some press articles over the weekend noted the market's placing really not much emphasis on the report, given the Fed's shift and Powell's statement on the shift away from being concerned about inflation and more towards the employment situation. So focus also will be on tomorrow's debate between former President Trump and Vice President Harris. Polling over the weekend continues to show an extremely close race, and so the markets and all of us will be interested to see how that turns out.
Hi, InvestTalk. I had a question about Tri Pointe Homes. The ticker's TPH. The home builder, it's a small cap stock, though. You guys have talked about large cap home builders on the podcast before, and I just wanted to see what you think about this one, some of the locations they build homes. I believe you guys have talked in the podcast how prices have gone up in those areas as well, and how typically home builders will do better than home buyers. So I just wanted to see what you guys thought of this one, and then also if you could answer on whether it's a good idea to have a small cap home builder as opposed to a large cap home builder. And I'll listen on the podcast. Thanks again, guys. Bye.
Tri Pointe Homes, ticker TPH, is, like the caller said, a small cap home buyer, about $4.5 billion market cap company. It's got a little bit of debt, not too much, $1.46 billion as of the end of last year. The most recent quarter, it's down to $1 billion, but they got $500 million in cash on hand. So their net debt is relatively small. Now, they have 3 business units that focus on home building. They have a financial services unit as well, but they have their West, their Central, and their East. And most of their revenue comes from their West, about 65% of their revenue. So that's focusing on California and Nevada and the Four Corners states. Now, the revenue growth has been pretty stagnant over the past 5 years, from $3.2 billion in 2018 to $3.7 billion last year, though that's projected to be $4.3 billion this upcoming, or as of this fiscal year end. Their cash flow has been kind of downward trending as well since 2020, though it's stabilized in about the 200 range. Its profitability, though, its margins have been improving from about 21% back in 2018, this is gross margin, to about 22% last year. Their net margins as well have been improving from 8.3 to 9.3% this year. And so the reasons why you might be interested in purchasing a home buyer now is, well, interest rates are coming down, right? These are very capital intensive businesses. And a problem that we've talked about a lot on this show, and you've probably heard elsewhere, is that homes are expensive, and it's not really because of interest rates directly, though indirectly it does affect this, but it's because there are not homes that are being built. Homes have not been built consistently and to the levels of pre-2008 since 2008. It is substantially lower than the levels of home building in the early part of the 2000s. And so, politically speaking, there seems to be a recognition of this issue now. And as rates come down, I can see over the next decade are ramping up in trying to build homes and making up for lost capacity over the past decade and a half. And so home builders stand to benefit there. Now, the issue primarily with small home builders is they tend to have regional concentration. And as we know, the real estate market is sure affected by national issues, but it's also affected by regional and local issues. And so if you don't have regional diversity, like a lot of the small caps don't, well, then that can be an issue. And that's why we tend to want to buy larger home buyers. Now, even though 65% comes from the Western area where there is a lot of home building happening, this still seems to be pretty regionally diversified. And so, it looks like a good business to me overall. It's trading at fine multiples. I mean, its price to book is about 1.3. Its price to sales is about 1. Its price to cash flow is about 24. So this is kind of on the upper end of where its 5-year average has been. And that makes sense. I mean, it's run up a lot in the past year, even with interest rates higher, about 41% in the past 52 weeks, year to date, up 18% in the 3-month, up 12%. So generally speaking, I think the business looks fine financially in terms of its balance sheet, in terms of growth in its income for this type of business compared to its industry. However, I think that given the recent run up in the past year, it looks a little overbought to me. And again, I think there are some risks with owning small cap home buyers, or home builders rather. I already mentioned them. Lack of regional diversity, though, is still relatively diverse. I would still tend to want to look towards those larger names. Thanks for the call. I hope you've been telling your friends and your family members and random people you see on the street that our InvestTalk audio podcast is also posted in video form on our YouTube channel. It seems like every day now we receive finance and investment questions from the comment section of our InvestTalk YouTube. And when we get those, we like to get to them as soon as we can. So let's get to one right now. And this one from Priya is on regulatory issues with Google. What do you think about the current regulatory issues with Google? And so for those of you who don't know, there have been several lawsuits, and there is another lawsuit that is going to put Google back in the courtroom. And the most recent one is about Google's ad tech. And the FTC and the DOJ are accusing Google of operating in a monopolistic way. And the reason why they're able to do that is because they essentially have been controlling all aspects of the digital ad sales market. And in a way, have been able to, according to the DOJ and the FTC, have been able to fix prices by controlling the buying side, the selling side, and running these auctions where they themselves can fix these prices to the detriment of consumers and advertisers. And so this is, like I said, one in a long line of antitrust cases, but it certainly is, in my opinion, probably the most, or rather the largest threat to Google's business since its inception. They've had such a dominant role in search and therefore ad sales for quite some time. And so you're talking about Google Search, you're talking about YouTube, a subsidiary of Google, and other businesses that could be widely affected by an adverse decision, including one that could be breaking up the company. And now the funny part about that is the market doesn't really seem to care much. And that could be for multiple reasons. They could be downplaying the market, that is, could be not accurately understanding the risks associated, which may not necessarily be the case. Or it could be that the worst case scenario isn't really a breakup, but more attuned to what happened with Microsoft in the late 1990s, early 2000s, and that the court sided with the DOJ and ordered that Microsoft be broken up. But after an appeal, there was a settlement that kind of restructured the way Microsoft operated. And so this is a big threat to the business. There are certainly risks out there. The market doesn't seem to be caring right now. And when the market doesn't tend to care about something, that could be an indication that the price is a little bit too high. So certainly this will be an interesting outcome, or rather people will be interested. I will be interested in the outcome, because not only could it affect Google, but it could lay the groundwork for a lot of other businesses that the government's been trying to break up or sanction for monopolistic activity. So all eyes will be on that. And certainly we live in exciting times. Now let's keep things moving and play another caller question now.
This is Andy from Atlanta. I was reaching out about KRP, that's Kimball Royalty Partners, and I wanted to see if you could take a look at it, see if this is something that I should take a position in. Love the show. Thank you.
So Kimball Royalty Partners, that is ticker KRP, is a royalty company that owns and acquires minerals, mineral interests in oil and natural gas properties. And so like these royalty companies, what you'd expect to see is not having to deal with the capital intensive, debt intensive aspect of actually opening up these mines, but rather just purchasing an interest in them. And so over the past 5 years, revenue has grown pretty substantially, about 33%, from 65 million to 273 million last year, projected to be 329 this year. In terms of debt, well, it's only got $297 million of debt on a $1.2 billion market cap company. Its dividend yield is sky high, pays a 12% dividend. And so, as we like to say, high dividends like that tend to signal some sort of distress. The price has fallen, and the dividend has either not been cut yet or will be cut in the future. It looks like the dividend is relatively unstable, about $1.65 per share, down to 87 cents per share 2 years later. Last year it was $1.73 per share. And the reason why it doesn't have any debt, it's issuing a lot of shares. They have doubled the amount of shares in the past. Actually, it's increased eightfold in the past 5 years. So this is a serial issue of shares that is generally making you assume that it is a healthy business, given the fact that it has very little debt. But it looks to me like shareholders tend to be pretty highly diluted. The stock has been falling pretty significantly this year, going back to October of last year. So KRP, Kimball Royalty Partners, I would stay away. Thanks for the call.
Hi, Justin and Luke. I was calling in to get your opinion on a bond fund. It's the Vanguard Short-Term Corporate Bond ETF. Was looking to put some money in to my retirement account for income. I'm not sure if this would be the right time since interest rates are going up. Would that mean that the price of the bonds would be going down? Just wanted to see what your thoughts are. So primarily, again, I would be just using it for income in my retirement accounts. So I'll be listening to the answer on your podcast. Thank you.
So ticker VCSH, the Vanguard Short-Term Corporate Bond ETF, is exactly what it sounds like. Invest in U.S. corporate bonds. It defines short-term as bonds that mature within the next 1 to 5 years. And this definition actually expands beyond what a lot of its competitors do, because typically short-term bonds are 1 to 3 year coverage. And so it looks like because of this, the weighted average maturity of the bond portfolio, the bond ETF, is actually 1 year longer than other ETFs in the category. Now, primarily it's focused on, or rather it is exposed to financial and industrial names, as would be expected in a short-term bond fund. And it does all of this for a net expense ratio of 4 basis points. Again, exactly what it should be for this type of fund. And so I will take a step back and say, you correctly identified the relationship between bond prices and interest rates, because when interest rates do go up, bond prices fall. And the reason that is because as interest rates rise, existing bonds have lower coupon rates. They're issued on lower interest rates. And so they're worth less as new issues that have higher rates are available. But what we're going to see in the short term is actually rate reduction. And so because interest rates are going to be falling, certainly in the short and medium term, what you'd actually see is a price increase in bonds. And now this doesn't necessarily happen, right, on the day the Fed makes the announcement. That's not how it works. The market anticipates these things. The market discounts different possibilities. And so each daily price of something is taking into consideration all of the range of possibilities here. But the general thing is as interest rates fall, bond prices tend to rise. And so the way to take most advantage of that is actually to go longer, because longer duration bonds are more sensitive to interest rates. Now, it doesn't seem to me like you're trying to invest in bonds long term. It kind of struck me as though you were trying to get some income now. And so when you take a look at this fund, whose long-term maturity distribution yield is about 3.68%. I think that's fine. But again, I think you can do more by maybe reaching a little bit longer towards medium-term bonds. But I will say that if you want to be in a short-term bond fund, this is actually a good one because it expands on that definition, because it's actually longer duration than other short-term bond funds. So if you're interested in a short-term bond fund, I like this one because of the longer duration, more exposure to interest rate risk, meaning that when rates fall, prices tend to rise more than just a standard short-term bond fund would. Thanks for the call. Now, as I've already mentioned, we love getting to our InvestTalk YouTube questions, but we also like to get to our InvestTalk podcast review questions from iTunes. And so JDC in Beirut has a question about PTY. It says, what do I think about PTY? Well, let's pull it up. PTY is presumably a fund that does not easily come up when I type it into FactSet. So let's take a look. And it looks like, do I finally have it? Unfortunately, none of these are coming up, so we're going to have to move on to a different caller question. I apologize to JDC and Beirut. Actually, let's shift back to a talking point. Let's blame FactSet on this one, guys. Well, interestingly enough, that last question, which unfortunately I could not answer because I don't want to just throw things off the top of my head. I actually want to look and see before I formulate an opinion on something and give you guys answers because this is important. But the last question was about bonds. It was about a corporate and income opportunity fund. And this next topic that I want to bring to you is also about bonds. And that's because this week marked a record-breaking moment in the world of U.S. corporate debt as companies rush to issue bonds ahead of potential volatility from upcoming economic data, a Federal Reserve meeting, and the looming presidential election. In a single day, 29 U.S. investment-grade bond deals hit the market, making it the busiest day on record for debt issuances. By the end of the week, borrowing across 60 high-grade issuers totaled nearly $82 billion. That means it's the busiest week since May of 2020. So what's driving this frenzy? Well, I hinted at it at the top of this, and several factors are at play. Borrowing costs fell over the summer, making it an opportune time for companies to refinance their debt, some of which is set to mature in the next few years. So as the average yield on investment-grade bonds fell to 4.8%, down from 5.6% in earlier July, the window for cheaper financing became too attractive for many companies to ignore. Additionally, there's a growing concern about potential market turbulence on the horizon. Senior debt bankers have pointed to upcoming economic reports, the Federal Reserve's interest rate decisions, and the fast approaching U.S. election as major risk factors. Among the notable deals this week were Ford Motor Credit's $2.5 billion issuance, a $4 billion debut from Uber. I think that might actually be its first debt issuance, and a $750 million bond sale by Target. These companies, like many others, are taking advantage of favorable market conditions to shore up their financial position before any economic or geopolitical surprise arises. Last month's weak U.S. payroll report served as, I would say, a reminder of how fragile the market economy can be and how quickly market conditions can shift. In August, recession talks surfaced for the first time in a long time, leading companies to act swiftly in securing their funding. Although the risk of a recession still remains low, it's higher than it was at the start of the summer, making treasurers more cautious about delaying their borrowing plans, and that makes sense. So as we look ahead, more economic data and another payrolls report are expected pretty soon. They come, well, every month and all the time in between. And so the Fed's meeting in September 18th, where markets are broadly pricing in a quarter-point rate cut, will also have an impact as well. But with a closely watched CPI reading due next week, though not as close as some other ones, given again the Fed is shifting away from inflation and closer to employment, we have to also consider that there's going to be a company buyback earning blackout period in October, and so the window for borrowing generally is shrinking. For now, companies are taking no chances, making this one of the busiest periods for U.S. corporate debt issuance in a recent memory. The question now is how long this window of opportunity will remain open as the economy, market, and politics continue to evolve. Now let's play another caller question. You know the number, 888-99-CHART.
My name's Brandon from Oklahoma, and I had a question for y'all. I've been seeing a lot of talks about, obviously inflation's real high and people thinking it's going to keep running high. My goal for retirement is, to have, I'll just say like at least $1 million. And then I hear replies about that saying, well, $1 million in 30, 40 years isn't going to be nearly enough due to, 7% a year inflation. And, they throw numbers out. I was just kind of wanting to get y'all's, take on, $1 million for retirement, say 30 years from now, because to me that would, at a 4% withdrawal rate plus Social Security and pension, I'd be bringing in more money than me and my wife working right now. So, I was just kind of curious y'all's take on, kind of, I guess, inflation of the dollar and what you need in retirement, is what you have today going to be enough then kind of thing. Thank you very much. I look forward to hearing your answer.
So this is an interesting question. And that is because I think generally speaking, people frame how much money they should have retirement in the wrong way. And I'm going to steal something from Ken French, who was on the board of directors at Dimensional, very famous economist and practitioner. And that is that the only uncertainty in life is, with regards to your finances, is actually about the level of consumption that you have. And so people think about retirement as a number, $1 million, right? $2 million, $3 million. And that's a lump sum, but that's not really answering the question, which is the risk you face is, well, two risks. It's longevity risk, running out of money, and your life extends beyond when your resources do. The other risk is not spending all your money or allocating it as you properly would. But I think you have to reframe your mind in terms of understanding not what your one number is, but what your consumption levels are going to be, right? What are your expenses? How do those expenses tend to grow? What do you want to do? Do you want to go on trips? Do you have financial goals? And then understanding how, outside of retirement, maybe you want to give money to your kids, give money to your grandkids, all these things. And so understanding what you have to do within that lens gives you an idea of how historically costs move, how historically asset prices move, how historically equity prices move. And then you can frame better solving that problem, which is generating those inflation adjusted returns that can provide you with that income over the long term. And so it's a complex puzzle for sure. It's one that, in a way, as a society, I think we haven't completely solved, because there are too many people that are, unfortunately reliant on social safety nets as they get older. And maybe they didn't save because they didn't want to, but maybe they didn't save because they didn't have the opportunity to. And so it's a very complex question, but I want to first and foremost kind of try and reframe everybody's mind that I don't think you should be thinking about a number, because the number itself changes, and what changes the number, well, what your consumption levels are going to be. So framing it through that can kind of give you a better picture of how much you need and how you need your money to work for you in retirement. That was InvestTalk. Let's go ahead and fit in another listener question now.
Hey, Justin, just had a question for your podcast. Love your show. I'm interested in ticker symbol CARR, Carrier. Let me know your thoughts, and I'll be listening on the podcast. Thank you.
So the ticker is CARR, and the company is Carrier Global Corp. It engages in the provision of building and cold chain solutions, offers heating, ventilation, air conditioning, refrigeration. And so it is a large cap company, $64 billion market cap company. It pays a 1.1% dividend yield, which is not massive, but certainly still something that can be beneficial for investors. And excuse me, year to date, it's up 23%. Past 3 months is up 12%. On the year time frame, it's up about 20%. And so with that, its revenue has been, it's been growing at a clip pretty similar to the rest of its industry. It went from 18 billion in sales in 2018 to about 22 billion last year, projected to be 25 billion this year. Its debt levels, pretty modest, 14 billion in debt. That's paid down to about 13.823 billion as the most recent quarter, but they actually have 3 billion in cash on hand. And so their cash flow has been steadily improving. Their relative strength has been improving. Their profitability has been improving as well. Their net margin went from about 14%. It's fallen from 14% back in 2018 to about 10% this year, though. Maybe we need to look at their EBITDA margin, which is actually projected to grow from 5 years ago, from 16% to 19%. So that's before you take into consideration interest and taxes. And so what you have here is a business that has been growing, a business that has been improving its cash flow, but also a business that is pretty expensive on a relative basis. It's forward-looking price to earnings about 23 times. Price to sales about 2.7 times, price to cash flow about 22.7 times. So, this is a business that has run up significantly this year, about 23%. And so their upside could be a little bit limited. I wouldn't buy into this momentum trade right here. It looks like it dropped a little bit from 73 down to 70, but I think it's trying to find some resistance. And given the most recent run up and how it is valued relative to how it's been valued over the past 5 years, with modest growth, but nothing too spectacular. It's certainly been in a theme that has been doing very well over the past 9 months. So good company, keep it on your watch list. I think there's a likelihood that it falls a little bit from here. I found it. I'm very happy I found it, because when you ask me a question, it's kind of embarrassing when we can't talk about it. So let's talk about it. The PIMCO Corporate and Income Opportunity Fund, 65 basis point management fee. It looks at dynamic asset allocation strategies among multiple fixed income sectors in the global credit markets, looking at corporate debt. And essentially what it is aiming to do is utilize this to maximize return within the fixed income space while taking into consideration convertible securities, all sorts of variable products. And so it's about 30% notes, 21% loans, a lot of mortgage-backed securities, a lot of longer-term fixed income instruments, some equity instruments as well, though that might be the convertible bond debt. And so when I'm looking at this, what I see is a return of this mutual fund that generally over the past, since inception, about 12% return. The $2 billion fund, its expense ratio, its net expense ratio beyond its management fee is actually 1.69%. I think if you're looking for equity-like returns, invest in cheaper equities. That's where I am right here. This is giving you, generally speaking, maybe a less correlated return to your equity sleeve. But if you're looking for higher returns, invest in equities. If you're looking for capital preservation, then invest in a fixed income fund that is probably going to charge you less than 65 basis points or 1.69% in terms of its net expense ratio. So glad I found it. I would give this a thumbs down. Now, before we head off, I wanted to talk briefly about efficiency. And efficiency is often pretty easy to see. But there's one surprising exception, and that's the stock market. And that's because, I wanted to talk about this because a recent paper by Cliff Asness, who works for AQR, he's a known hedge fund investor, touches on this topic. And so we tend to think of market efficiency as prices reflecting all available information, the idea that was pioneered by Eugene Fama, who won a Nobel Prize for his work on market efficiency. He was on the board of directors of my past company. And in some ways, I would say the stock market is more efficient today than it has ever been. When you think about electronic trading, which took off in the 90s, it's made trade processing lightning fast, nanoseconds. There's also more information about every single stock. It is covered by more people around the world. And trading costs have plummeted. And when more people are participating in trading, prices tend to be more efficient. But one thing that Asness points out is an important distinction between speed and how it doesn't always equal precision. Sure, stock prices might react faster to news, but that doesn't mean that those reactions are accurate. One piece of evidence comes from something called value spreads, where it measures the gap between what investors pay for the most expensive stocks and the cheapest ones. In the 50s through the 90s, these spreads were relatively stable, but ahead of the dot-com crash, they spiked. And since then, they've been climbing steadily again. This suggests that investors may be paying more for certain stocks than they're worth, but it's not easy to pin down why. And so Asness offers three possible explanations. The first is that low interest rates over the past 2 decades have skewed traditional measures of value. But with rates now at positive levels, maybe the argument's a little less relevant, though probably still has a role it played. The second is a popular one, and that is the rise of index funds has crowded out smart investing. Before index funds, the market was a mix of sharks or informed investors and minnows or less informed investors. But if these sharks have given up in favor of indexing, it could make it harder for professionals to correct mistakes. The third explanation, and the one that I would say he and I find more compelling, is that social media has turned the market into a casino. With 24-hour trading, smartphone apps, social media influencers hyping stocks, the market has become a breeding ground for speculation. Warren Buffett has actually echoed this sentiment as well, noting that today's market exhibits far more casino-like behavior than when he was young. But what does this mean? What does this mean for everybody? In theory, a world where the masses are making big mistakes should be a good one for informed investors. But the challenge is whether you can hold, whether you have the nerve amidst the chaos to wait for corrections. And so I would say while technology has made trading faster and cheaper, it hasn't necessarily made markets or people more rational. So for long-term investors, the key might be to tune out the noise, stay disciplined, and resist the temptation to play in the casino. Well, I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And be sure to rate and review us on iTunes. Please also tell your friends and family members and random people on the street that we have an upcoming wealth webinar on October 8th that will focus on effective strategies for managing your 401ks and enhancing your retirement savings. Independent thinking, shared success. This is InvestTalk. Good night.